In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome everybody. Merrill Chandler here, your host of the Fundability podcast. And I've got an amazing opportunity today in our guest, Jason Hartman. I heard him in a presentation about a month ago, and he blew me away with not only his acuity in the real estate investing marketplace, but of an amazing grasp of what has happened, what is currently happening, and what is likely to happen in the future. And he's here to tell you that for himself, so you could be as blown away as I was. Jason Hartman, welcome to the Fundability podcast.
Hey, Merrill, thanks so much for having me. And I hope I can share some great insights for your audience today on really peeling back the different layers of the onion when it comes to analyzing the real estate market and the macro economy in general. There's just so much misinformation out there nowadays. And I am absolutely really kind of shocked at how few experts really understand the dynamics of the market. They've virtually all been wrong. In fact, I don't know if I have it on the slides to share with you today, but I have shared it a lot on my podcast and my YouTube channel. And that is a whole list of all these predictions by all of these different organizations, whether it be Zillow, Redfin, Fannie Mae, Freddie Mac, Goldman Sachs, et cetera, et cetera. And they were all wrong. Every single one of them was just wrong about how this year would turn out. And now they're all starting to make predictions for next year.
24, yeah.
I just kind of stick to some pretty simple market dynamics. And so I'll share those with you today. But before we dive into that, maybe I'll just tell your audience a little bit about myself in case you're not familiar with my work. My name is Jason Hartman. I've been teaching people about the real estate market, about long-term buy and hold real estate investing for almost 20 years now. Before that, I was in the traditional real estate business. I owned a traditional real estate company in Southern California. Coldwell Banker purchased it from me in 2005. At that point in my life, I could have easily retired, but I'm just not interested in retirement. It's not about money. It's about a mission. I became financially free a long time ago, but I just really like teaching and sharing what I learned from all of the interviews. I've done over 2,000 interviews just on my main podcast alone. And so I'm talking with experts and economists all day long about real estate, about the techniques, the strategies, the market, the economy. And really, I hope to answer the question of, what should I do next? How should I react to all these fundamental things that are happening in the marketplace so that I can not only protect my wealth, but grow my wealth? And when I say I am speaking to the listeners, like what you would say. And so hopefully I'll share some of that with everybody.
Well, I gotta tell you, this audience is no stranger to peeling back the curtain and looking at the machine, right? That's what Fundability is. We help people get a look at what banks are actually evaluating rather than this credit score, this mystery three-digit number that people have been trained. So we have an entire course called Credit Myths Exposed, just like you're exposing myths, that misrepresentation. So my audience is highly tuned to hear what you have to say about pulling back the curtain and seeing what's actually happening out there.
Sure. Good stuff. Well, it sounds like you got some myth busters in the audience, so that's good to hear.
Yeah. Well, in fact, our entire business metaphor is the financial matrix. Yeah. And how do we wake up and see the truth and actually leverage opportunities since we know the truth?
Yeah, there are definitely a lot of very powerful people and institutions conspiring against people financially. You know, I always say that Wall Street, really the core mission of Wall Street is to separate the middle class from their money, and they do a great job of it.
They
you
do
know,
a
you got to hand it to them.
spectacular job.
And so you know, hopefully we'll help people gain more control. But you know, before we get into the market, I just wanted to talk about this landmark case.
Brilliant.
Literally was just decided, and I thought I'd be remiss because I literally just got the alert on this before this show. And some people may not know this, but there has been this giant lawsuit that's been going on by various people accusing the National Association of Realtors, which is the largest trade lobbying organization on planet Earth. Okay. It's about 1.5 million people. It's a huge organization. I used to be a member of it years ago when I was in the traditional real estate business. I'm not in that business now, so I'm not really, you know, affected by this, I don't think. But it is interesting. So against NAR and a bunch of different brokerages as well, big name brokerages, you know, Home Services, Keller Williams, and the accusation was that these groups were colluding to increase commissions and, you know, I guess violating antitrust laws. You know, I'm not a lawyer, so I don't know the super details about this case. I haven't been following it a whole bunch. I've just been kind of keeping tabs. But now there is a verdict, and they found that these groups were guilty of this. And the defendants have been ordered to pay damages of, I hope everybody's sitting down because this is huge, $1.78 billion.
Almost $2 billion in damages.
$2 billion, yeah. So this is really a landmark case that will change the real estate industry forever. This is a big deal. Okay.
So what are the big dominoes that are coming as a result? Because they're going to appeal, but let's say they uphold. What are the big dominoes when it comes to, is this a price reduction in that 6% on each side of the buyer and the seller is no longer the status quo, or what do you see?
Yeah, well, I think 6%, you know, now look at commissions are not fixed by law. That's the whole point.
Yeah, that's the point, right?
Like, they're negotiable between buyers, sellers, and agents and brokerages, you know, on each deal, which is individual. But, you know, the realtors have kind of like, for many years, they sort of tried to set this standard of 6%, right? Yeah. And then as prices inflated, it really kind of became more like 5%, right? That was more common. And, you know, but again, it's not set by law. It's certainly not fixed. Everybody can negotiate their own deal. But just by the sort of the dynamics and the nature of the way the multiple listing service works, you know, there is a case to be made that, you know, you can't really negotiate that much, you know, and I guess that's what the plaintiff did, is they made that case and they won. So,
right.
You know, it's just quite interesting. I don't know what the effects will be yet. You know, I honestly haven't thought that much about it, but I can tell you this is a big deal and it will shape the industry for sure. Now, let me just make a statement. Considering that I've had a real estate license ever since I was 19 years old. I got my real estate license my first year of college. A lot of people might think I'm a trader by what I'm about to say, but I have for many years, even when I was in the traditional real estate business, been outspoken saying commissions are too high. Okay.
Right.
But wait, there's more. Okay. So I'm not a trader. Okay. To my industry. Here's what I think about that. When you really dissect this and understand it. Okay. I do think it, you know, look, when realtors charge 6% back in 1900, okay, or 1903, houses cost, you know, $1,000, okay, and the price of real estate has traditionally risen faster than the rate of inflation,
right?
And those commissions are paid on the debt and the equity, okay, right, and real estate is a leveraged asset class. By the way, I don't know why that thing's going on the screen. That's the AI that Zoom has.
Right. We're like, yes, we
Yeah, I know
affirm
it
that
does
what
weird.
he just said.
Sometimes it does balloons. Okay, so to buy a hand gesture, I got to fix that. Anyway, so so the fact that real estate is typically a leveraged asset class, meaning people get a mortgage when they buy the home, right?
Right.
The amount of commission versus the amount someone would pay for the house has vastly, it's been leveraged too. So it's grown much faster than the rate of inflation. But what this has done, because there's virtually almost no barrier to entry to getting in the real estate business. So everybody and their brother has a real estate license. I mean, there's a joke where I'm from and spent most of my career, the Socialist Republic of California. I now live in Florida, the free state of Florida. But there's a joke in California that when you get pulled over for a traffic ticket, the police officer, they say, "May I see your license?" And you say, "Which one? My real estate license or my driver's license?" Because everybody's got a real estate license.
Right.
So the problem is that, yes, I do think commissions are too high, but at the same time, the real estate people have to charge those high commissions because they have to spend such a ridiculous amount of money on marketing to attract the customers because the field is so crowded.
Right.
And that is a dysfunctional business. Right. So if fewer people
True
work
red
in
ocean.
the real estate business because maybe it wasn't so mega lucrative, right?
All right.
Then the practitioners in that industry wouldn't have to spend so much time and money on marketing, and they could spend more time actually doing their trade, their practice, right? Then commissions would go down, and realtors would have a higher volume of business that they wouldn't have to fight for and market for so much.
Right.
And that would be a more functional market, but it's dysfunctional. So
truly.
We have what we have.
Madcom, a true red ocean, right? Where everybody's fighting for the same few buyers.
Red ocean, yeah, that's a good, it's not a blue ocean. Yeah.
It's definitely not a blue ocean at this point. So, well, thank you for that. Literally, you heard it here first. Yep. A landmark case in real estate and commissions and damages for colluding, right? For all the parties involved trying to keep these rates artificially high. There's a group here, a kind of a fintech, but they're a real estate fintech called Homey, and their whole thing is it's 1%, and they get all these services, and so there's room for people to optimize the real estate buying and selling process, and people are doing it all the time. But there's still, like you said, it's not a law, but yet people, it's similar in credit. You believe that something is true because it's been done for 50 years, right? And so everybody believes 6% is justifiable, and so thank you for that. Now, to the original point of why I invited you to speak to my crew is that let's touch on what's happening in the market recently over the last couple of years, right? Today, and what we're seeing likely for the future, because what the deck you're about to share with us is the one I saw, you guys, and it blew my mind. I'm literally running up to the stage after he finishes his presentation, says, "I want you to talk to my community." So,
absolutely.
Jason.
And Merrill, this isn't the exact slide deck you saw, just for the record. It's a little bit different, but a lot of the same points here. So, what we've got right now is we've got a lot of doomerism out there, a lot of fear porn, a lot of people spreading bad news. And, for most of our history as people on this earth, our minds were trained to look at the negative because that's what helped us survive. And only since the Industrial Revolution have we lived in this world of amazing abundance, really.
Possibility, yeah.
And so, but still our old brain looks for negativity and hones in on it. And we need to train ourselves away from that because the world is a much more abundant place than it's ever been in history. Okay. And, you just got to zoom out and look back on a bigger space of time. Don't look at the last year. Oh, interest rates are through the roof. I get it. But, look at just back up a little bit and look at the big picture, right? So this is equivalent to people really playing on playing on our primitive emotions, right? When they're
Lizard
out there with
brain
these,
being affected by the fatal nature of what's happening to us, right?
yeah, they're out there with these clickbait titles. You
It's
surf around the
crazy.
internet, you surf around YouTube, oh my God, the world's coming to an end, yada, yada. And, ever since Malthus, got the
Yep.
name Malthusian economics, which was this whole idea that the world would run out of food due to overpopulation and we'd all perish, right? Well, the complete opposite happened. I mean, everybody's fat and eating too much food, okay?
Yeah.
So, all of these doomers have really just always been wrong. And we need to
Right.
realize that. I mean, one that I had on my show, I've had Peter Schiff on my show, Howard Ruff, a bunch of doomers over the years. And I remember, like, if you look at the history of, say, Howard Ruff, for example, he's this gold bug Mormon guy,
Yep.
back to the 70s, he was writing about how the world was going to end. You better stock up on food, all this stuff. And like the complete opposite happened. All these people have always been wrong. Peter Schiff has been wrong, just over and over. Now, look, a broken clock is right twice a day, okay, as the saying goes. And, Peter Schiff has published some videos, for example, saying, he was right about the Great Recession. Well, he's been predicting doom and gloom since 20 plus years since I've been following.
So he's going to get it right at least.
So eventually you're going to be right. Okay. I mean, that's not a legitimate track record. Okay.
But by the way, I do have to just insert there before we leave Howard Ruff. He lived in Modesto, California, which is where I grew up. He moved back to Utah, and I actually dated his daughter Pamela. So,
wow,
so
that's
I was
amazing. Yeah,
he's
got like 76 grandchildren. I mean,
no. Well, I was in the middle of that gold, the gold bust, the gold boom, right? Buy gold, the world is ending, and
80s,
I was intoxicated because I was part of the family, right? So it was fascinating to be there live in 78, 79, when it was just literally post oil, the oil embargoes that we had, that was all proof in the pudding. Yeah. So Schiff is part and parcel, two peas in the same pod, right?
Absolutely. And look, the thing people underestimate is that virtually every human on Earth gets up every day, 8 billion people, and their whole day is about, how am I going to improve my life and improve my situation? That's pretty much, I mean, can you imagine the power of 8 billion people doing that?
Right.
That's
just
what keeps the economy going. Okay. Yeah. That's what creates innovation. Everybody is always thinking about, how am I going to better my situation? How am I going to improve my life? How am I going to gain more abundance? Right? That's what we do as humans. We have constructive discontent. We have egos, and those egos drive us to achieve things. Okay. Yeah. The ego is not all bad. Okay.
I completely agree. We wouldn't be anywhere without it.
We wouldn't be anywhere without the ego. If you wouldn't have progress if it wasn't for ego. So
yeah.
Anyway, look, here's what really happened. Okay. As all the people were predicting the real estate crash, look at what happened. We saw the cyclical markets on the West Coast get a little bit of a hit, just a tiny amount, where they dropped just a little over 2%. Whip-de-doo. That's hardly a crash. Okay.
Right.
Some of these other markets next to them, Arizona, Nevada, namely, they dropped a bit to 0.06% collectively.
Barely. Yeah.
And the rest of the country has seen massive appreciation. In fact, when everybody was been predicting we're going to go into a recession, we saw the GDP grow like amazingly in the last quarter, 4.9%. I mean, it's just the engine of innovation and technology, and the ambition of people just keep pushing this thing forward. Right. Okay. It's a very powerful thing. If you look here, homeowners, they don't want to sell their homes. They have these incredibly cheap mortgages. I predicted this back right after COVID started. I knew that the Fed was going to ease to avoid a problem with the economy. And as unemployment was, projected to approach 40-something%, okay, I mean, it was like devastation, right? Of course, the centrally planned economy in which we live, all these central banks around the world were saying we got to flood the world with money, okay, with currency now, to keep things going. And so they did do that. And we saw the largest expansion of the money supply in any of our lifetimes. And we saw these ultra cheap mortgages. And the Federal Reserve basically put what I call a poison pill into the housing market. Now, I say poison pill like it's a bad thing, but it could be a good thing depending on what side you're on here, right? So the poison pill is this, is that these extremely low rate mortgages last for 3 decades, and they are going to cause a lock-in effect. They are going to cause a golden handcuffs effect on the marketplace, where people simply will not want to give up the mortgage asset. Most people think the house is the asset, the mortgage is the liability. That's wrong. The mortgage is an asset, especially
it's 3%, right?
Yeah, especially when a couple of things happen. Number one, the mortgage is below current market rates, which it is way below.
Right.
The mortgage is below the rate of inflation, either nominal or real inflation, which it is. Or you get to pay the mortgage back in cheaper dollars through inflation. Now, this is a strategy I created about 20 years ago, and I trademarked this strategy. I'm kind of become a little bit famous for it. It's called inflation-induced debt destruction. And what it basically means is that you borrow money at today's dollars and you pay the money back at tomorrow's cheaper dollars that have been debased by inflation.
Got it. Yep.
It's an amazing hidden wealth creator, Merrill. So we have this lock-in effect, and people don't want to sell their mortgages. Let's look at some of the stats on that. 45% of the existing mortgage market has a mortgage at or below 4%.
Wow.
Okay. A smaller percentage of the market, 26%, has a mortgage below 3%.
But still that's a quarter of the market.
Yeah. And collectively, the size of this market is over 65%. Yeah. Okay. Now, that is shocking. Okay. These people are extremely comfortable. And here's one of the giant mistakes all the predictors of doom have made. They have totally screwed up, okay? Because their myopic view of the situation is this. Oh my God, mortgage rates are extremely high. Housing prices are extremely high. Housing affordability is the lowest it's been in 40 years. This is going to cause a real estate crash. Wrong. Why is that? Because the simple, most basic law of economics is supply and demand. And there is one ingredient that you absolutely must have if you want to have a housing crash. And that is millions and millions of distressed homeowners that must sell their home quickly.
Yeah.
We have the complete opposite of that.
Everybody's hold.
The myopic people, they look at what's going on today and over the past year, which only really affects about 4 million homes. What they don't look at is the important part, which is what happened a couple of years before that, which affects about 136 million homes. Okay, that's the market. Okay, looking at today is not what's important. What's important is what happened during the COVID era when virtually the entire country either purchased a new home or refinanced their existing mortgage and locked in these very low rates. Those people are the people we need to be considering. Now, 65% of the country has a mortgage at or below 4%. A very, very comfortable mortgage payment. In fact, if they sold their house or got foreclosed on, it would be more expensive for them to rent than it is to stay where they are and just own that house. Right. And guess what, Merrill? The poison pill that the Fed put into the market has 28 years left on it.
That's it. That is a productive. That's a lifetime for a productive employee.
It's a generation.
Yeah.
Yeah. And so these people are not going to be in a position of hardship. It's very unlikely. Now, of course, there's going to be some. I mean, you're always going to have some hardship in any market, right? I mean, the foreclosure rate today is like non-existent.
Yeah.
Okay. Like, I mean, there's just hardly any foreclosure. If, you know, there's a whole segment of the real estate industry that is in the foreclosure business, you know, title companies that specialize in foreclosures, real estate brokers that specialize in foreclosures, contractors that do rehab and remodels for foreclosures. They're all like starving. There's nothing for them to do. There's just no foreclosure market at all to speak of. We have one of the lowest foreclosure rates in history right now. It's just like hardly anybody's in default. Why would they be? They've got these incredibly cheap mortgages. Okay. So this is the important thing. Now, here's what I didn't tell you. One of the things I always talk about on my podcast and my YouTube channel is this great saying, or really philosophy, or maybe mental model. And that is, you can't hear the dogs that don't bark. You can't hear the dogs that don't bark. Now, this came from a Sherlock Holmes episode, okay? And Sherlock Holmes, the great detective, found out who done it, who murdered someone, because the dog didn't bark. And so he knew that the dog must have known the killer.
Known who it was.
And that's how he found the killer. It's because the dog didn't bark. So what am
I saw that episode.
Yeah, I know, it's famous. Okay. So what am I not telling you when I say that, hey, you know, 25% of the country has a mortgage at or below 3%, 65% of the country has a mortgage at or below 4%, very comfortable people that aren't experiencing any hardship? Well, here's what I didn't tell you, which is even more amazing maybe. 42% of all the homes in America have no mortgage at all.
So we're still talking that these 65% is above and beyond the no mortgage crew. That's the 65% that are below 4% is of the people who have mortgages. Not the 25% who don't have. But there's 42% of the country that has no mortgage at all. That's so almost crazy. Half of the homes in the country are free and clear. Newsflash, people. It's very hard to go into foreclosure if you own your house free and clear. Yeah, tax now, granted, sales you could have on the random or something, but that's such a small. It's like a nothing burger. Okay, so that's where we are. This is the important part: is who has the existing mortgages. Okay, that's the thing. Now, 3 types of markets in the country: linear markets, cyclical markets, and hybrid markets. These act very differently. And let me just go over that real quickly, okay? A linear market is like the markets we recommend that people invest in. Okay, we've done tons of business over the years in Memphis, Tennessee. Linear market, it's boring, it kind of chugs along and has little ups and downs, not very pronounced, not a big deal. Same with Indianapolis, another one of our markets, okay? Little ups and downs, not very pronounced, kind of boring, okay? But take where I grew up, for example, which is a cyclical market, Los Angeles, California. Look at this, ups and downs, glorious highs, glorious, really ugly lows. You know, this is a market that is absolutely has these huge gyrations, okay? Right. And this is the kind of market that never has good cash flow. It's landlord unfriendly. It's not a market you would want to invest in. Okay? Right, got it. Too hard to predict the swings in prices, and the cash flow will be terrible in markets like this, okay? So we stick with these good, solid, linear markets that are the conservative markets. Now, another interesting thing when I talk about the existing homeowners and their position, like how do they feel right now, right? You know, are they struggling? Well, this chart is from the Federal Reserve website, and it shows the mortgage debt service payments as a percentage of disposable personal income. That's what this chart is. Now, you see during the COVID era right here, this is real small, okay? So you got to look carefully. During the COVID era, the percentage of mortgage debt
in comparison to disposable personal income was the best it's been since like 1980. I mean, houses were so affordable. Why is that? Well, mortgage rates were incredibly low and house prices were incredibly low too. The prices hadn't gone up yet. Okay.
Right.
Now, of course, we have higher mortgage payments now, for someone that would buy a home today, right? Housing affordability is very low. And then we also have higher prices. So this affordability has gotten a little bit worse. If I was to create a headline, a title for a YouTube video, I could say, housing affordability sinks. People are under much more pressure than they were 2 years ago. That would be true,
Right.
but it wouldn't be true enough, because the big picture is, even today, their mortgage payments are vastly more affordable than they were leading into and during the Great Recession,
Right.
at any time after that until the COVID era, and all the way decades and decades before that to 1980. People are very comfortable in their existing mortgage situation right now. What they've basically done, Merrill, is they've gone back in time. They got into a time machine. Anybody who either purchased or refinanced during the COVID days got into a time machine. Their mortgage payment that they got in 2021 was $1,001. That's the exact median mortgage payment in the United States in 2021. And that was on a $397,000 house, the median
Which is
price.
legit.
Okay.
Truly.
10 years earlier, if you go back 10 years before that, a whole decade before that, you go back in time, the median mortgage payment was $18 higher, not lower, higher, on a house that was quite a bit cheaper, at only $225,000.
Right.
Okay. So, but wait, there's more. Okay. You have to adjust this mortgage payment today and the house price today for inflation. And about 26% or 27% actually, inflation has occurred since then.
Right.
So really, the mortgage payment that the vast majority of the country has, we have about 140 million housing units in the US,
Right.
about 136 million of them have a mortgage payment that is equivalent to just over $700 a month in 2011 dollars.
In 2011 dollars.
Yeah.
Got it.
They are extremely comfortable. They're better off than the people in 2011 were.
Right.
By
It's
27%.
Yeah. $200 less expensive.
Yeah.
Based on those
Almost $300
relationships.
less.
Yeah.
Yeah. So here's the foreclosure activity. REO means real estate owned. This is Fannie Mae's reported number of REOs, which is like non-existent.
Abysmal. Yeah.
There's just nothing to do. There's just no foreclosure activity to speak of. Here's the mortgage delinquency rate. End foreclosures by, are they 30 to 60 days delinquent on their mortgage? Are they over 90 days? Are they in the foreclosure process? There's like nothing going on here. Okay. I mean, this is just a non-issue almost. There's always a little bit of it, but it's hardly anything to speak of. And here's the single family serious delinquency rate. This is 90 days plus facing foreclosure. And, again,
nothing.
It's like nothing's happening here. Okay. Existing home sales are way down. And a lot of people, Merrill, have confused sales volume with sales prices. Those are very different things.
Yeah.
Okay?
Explain that, please.
Yeah. So I think a good way to look at it is, for everybody, just for a moment, everybody listening, is, don't close your eyes if you're driving, okay?
Yeah.
Imagine. But if you're sitting in a chair at home, close your eyes for a minute and just visualize your kitchen sink, okay? Your kitchen sink. I'm not joking, okay? Visualize your kitchen sink. Mine is stainless steel. It's got one of those nice faucets on it that you pull out, and it has all these adjustments and stuff. And it's got some beautiful white and gray quartz countertops. Okay, that's my kitchen sink. So visualize yours, and let's look at the real estate market in terms of a kitchen sink. Okay, And if we picture that the faucet is the new listings coming on the market or the new homes coming up for sale, whether they be new construction or resale properties, the faucet right now is just trickling out a little bit of water. Hardly anything is coming onto the market because nobody wants to sell. And so the faucet's at a trickle, it's barely on. And the basin of the sink, that represents the existing inventory in the marketplace, okay? Now, compared to a normal market, our existing inventory is only about 45% of normal. So it's very low. We have very little inventory.
There's no churn going on out there.
Yeah. Less than half of the inventory we should have, okay? So the basin of the sink is about 45% full. If you consider that the water being filled to the brim is a normal market, and the water overflowing onto the counter and onto the floor is a buyer's market where it's considered a bad market, right? So the sink is only about 45% full. It's far from even normal. We don't have enough housing inventory. Inventory is very low. And then we look at one more component, and that is the absorption rate of properties that come up for sale. How many properties are being purchased that are, for sale, right? What is the buyer demand? What is the demand side of the equation? Well, the drain is a little clogged right now because the demand has definitely declined because housing affordability is the lowest it's been in 40 years.
Right.
So the drain, whereas during the COVID era, the drain was wide open and as much water that would come into that sink, it was being sucked down the drain.
Right.
The buyers were buying everything with multiple offers most of the time, right?
Yep.
Well, now we have this situation where the drain is clogged by anywhere between 15 to 30% clogged. So most of the drain is open and it's draining and people are buying, but it's more clogged than it used to be. Demand has declined. But unless the faucet is turned on, at a higher rate and more water comes out of the faucet, more listings come onto the market.
And new construction. Yeah.
There's not enough new construction to get anywhere close to meeting the demand.
Right.
We're just not going to have a real estate crash until that happens. Until we have millions of distressed sellers, there's not going to be a crash.
That is amazing. Okay, team. Did I just tell you why we're doing this? That Jason has just an amazing perspective for us to be able to see, because people ask me all the time, fundability is the ability to get funding, right? To hit the underwriting bullseyes and get funding. Rates are up, but the funding bullseye is still the funding bullseye, and lenders still lend. $50,000, $100,000 business lines of credit. But everybody wants to know, so what do I do with my money now, right? And so they're afraid that they're going to lose it to either inflation or, and the beauty of a credit line is every time you use it, you're using the same dollars for less expensive. So your model of this, a cheaper dollars model, is fascinating when it comes to
Merrill, your point there is interesting because people really have to remember that when it comes to real estate investing, it's look, if you invest in precious metals or cryptocurrency or non-dividend paying stocks, those are one-dimensional asset classes. The whole strategy is very simple: buy low, sell high. End of discussion, right? There's nothing else to do there, right? Buy low, sell high. You're speculating and betting that the asset price will go up, okay? Right. With a dividend paying stock, it's buy low, sell high, get some dividends in between. It's two-dimensional, okay? With income property, there are all kinds of dimensions. It's a multi-dimensional, beautiful asset class. Buy low, sell high, get cash flow, get tax benefits.
Appreciation, all of it.
Leverage, everything, right? But also get my thing, which people don't recognize, which is inflation-induced debt destruction. Yeah. That is huge. Okay,
Yeah,
that's the hidden wealth creator.
I love that. I'm gonna I recommend you guys look at Jason's YouTube and podcast, especially search for those episodes about that, how to leverage today's dollars against tomorrow's debts, because the debt stays the same on a business loan. You're just paying it off with cheaper dollars. So that is an amazing that is an amazing. So how do our thank you for this. This is exactly what I wanted my crew to be able to understand. There's a lot of the naysayers out there, like you said, the doomsayer, the doomsters, are, it's all clickbait. Everybody has something to sell that is trying to push you to believe that Chicken Little in the world, the sky's falling.
Sky is falling, yeah.
So I'm thankful for this, because I hold the same. I do not have the acuity you have of this side of it. I just watch. The banks have been doing this for 500 years, so I draft behind them in what they're doing, and these roll-ups, all these things just become more and more larger conglomerates with more assets to leverage and lend against, right? And so I draft behind the top 10, 15 banks, and I do not see a crash coming, but from a different perspective. So seeing yours, and I'm like validated out the wazoo, because who's holding all these mortgages, even if they're at it's all the pension funds have been sold these massive $100 million securities at these low rates, but they are forever, right? They're for that 28 years left on those payments. And so there's a stability in pension funds, in retirement accounts that have invested in these funds and ventures. So again, it feels great feeling right about it, even though I wasn't right the way you're right. So,
yeah. Well, Merrill, I'll tell you something though. We're not going to be right forever. Let me just say, there will be a real estate crash. ... someday.
Yeah, right. Because everybody's
there's always
right
cycles,
at least twice,
folks,
right?
okay? Like, nothing lasts forever. But look, as long as you watch the inventory levels. Okay. When inventory starts to bump up near 1 million homes for sale, now it depends which survey you're looking at.
Right.
The one I'm using only counts actual for sale listings versus some of those surveys count pending and contingent sales, which I think that's inaccurate. That's the way NAR does it. I don't like the way they do it. So, but whatever. If you compare apples to apples, it's okay. Just watch the inventory numbers. As long as they're below normal and people have these mortgages that are cheaper than the rate of inflation, cheaper than current rates, and they're paying them back in cheaper dollars over time, that mortgage is an asset to them.
The trifecta, yeah.
Okay.
That's brilliant.
Yeah.
Thank you again. And as you can see on the screen, for those of you who aren't driving, it's jasonhartman.com, jasonhartman.com, Hartman. Make sure you go there and explore his universe, because it's been a blessing to me and the people I rub shoulders with in the masterminds that I am in. There's a lot of people who count on Jason to be a voice of sanity and reason when there's a lot of BS being broadcast out there. The mythology is running rampant, and the withholds are crushing the souls of people who don't know the truth yet. And you know me, we're gonna bust every myth we can. And Jason, you've helped us do that today with regards to real estate.
And Merrill, thanks for having me. Check out my YouTube channel and my podcast. Those are probably the best things. And go to jasonhartman.com, sign up somewhere on our site, get on our newsletter list, so you'll get our newsletters with very in-depth analysis, charts, graphs, all kinds of cool stuff that'll keep you interested in the whole topic.
It's been a pleasure, Jason. Thank you very much. And we'll stay in touch. I'll definitely see you in the family events, but thank you again, and we'll talk soon.
My
Everybody,
pleasure. Happy investing.
Have a brilliant and wonderful weekend. I guess wherever you are and whenever you listen to this, there is hope. make sure that you round up instead of rounding down, and life will tend to be far better for each one of us, regardless of our life situations. Godspeed. God bless. Thank you, guys. Bye now.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast because we want them to get fundable too.